Now, for more on the latest rumblings from the Federal Reserve and also the rest of today's market action and what to do with your money, more pointedly, we're joined now by Michael Harkins. He is the partner and president at Levy Harkins Company. And last year, if you happen to have an account at Levy Harkins, you can celebrate a little bit. You gained about 27%. Not bad, Michael Harkins. Good to have you with us.
Thank you very much, Pimm.
And you've just returned from Blighty, right? You were in England. You were a speaker at Jim Grant's Interest Rate Observer Conference. And you started off with a little bit of the description of your relationship, academically anyway, with John Maynard Keynes, right? And yes. I read that you were, as a college student at Cornell, you were sitting in the library stacks. They don't have them anymore now. It's all digitized, of course. Sadly. And you were reading John Maynard Keynes. Why did you decide to open your speech talking about the eminent economist?
Well, because he was my boyhood hero. I went to Cornell. I read him. I was besotted instantly. And within a fortnight, I had consumed all of his major works. Even worse yet, I'd started using words like fortnight and besotted. I was instantly addicted. But he really was the man who saved Western capitalism. In 1935, when he was writing the general theory, they were taking it over to Washington in galley proofs, hoping against hope that they'd know what to do next to get out of this grinding depression. And for people who are, much younger than I am, who think this is the worst time America ever had, this isn't even remotely as bad as the Depression. And we didn't know our way out of it. I mean, unemployment reached 27%. House prices were devastating, even worse than this. And he came up with a theory of getting us out of it. And it really is the most important thing that's happened in the world of ideas in about 100 years.
Now, you also note that there is a little bit of personal history, which is, well, if you know a little bit about the person, you know a little bit about their philosophy. He, at one point, you say, almost or indeed cornered the wheat market. He was a trader.
He was a trader. He was a legendary trader. He tried, when he got forced delivery by the shorts, unexpectedly. And he proposed to the Cambridge Dons. He was a famous lecturer at Cambridge, was never a professor, interesting. And he proposed to the Cambridge Dons that they should allow him to store his wheat in King's College Chapel. It never actually happened. But imagine the cheek in trying it on. So when I was a kid reading this, I thought it was fabulous stuff. Then many years later, in 1991, I read Robert Skidelsky's brilliant biography of Keynes.
And you're going to tell us more about it, because I want to find out how that wheat trade actually ended. It was profitable. We've got more with Michael Harkins. And Michael, I want to give you the opportunity to at least fill us in on that wheat trade that John Maynard Keynes initiated, because he was a pretty savvy guy as well as a smart economist.
He was a smart economist. He got forced delivery. He wound up demanding that the wheat wasn't clean enough. He got the sellers to clean it. Took a couple of weeks. In the interim, the price of wheat recovered, and he traded out in a profit position. So knowing all that as a kid, I thought, oh my goodness, we can all do this, can't we? It took Robert Skidelsky's brilliant biography of him.
3 volumes.
3 volumes.
There you go.
But in the first one, Economist the Savior, I discovered, yes, in 1929, he almost went broke. And in 1931, he couldn't sell his 2 best paintings. And he never confessed to any of this. In 32, he changed his investment philosophy completely. He died in 1946, making 23 times his money from the moment that he stopped pursuing his own economic theories and started becoming a value investor. A closeted value investor.
Well, that highlights a very important point that you made in your presentation, because it indicates that so many professional investors have ruined themselves and their clients because they follow almost blindly some kind of theoretical notion of what's going to happen in the future.
Yes, and I must say, you're very kind to me. Robert Skidelsky did all that brilliant biographical work.
You read it, so I'll get you the half credit, half point there.
Half point. Yes, they do, and I see this all the time. People following, and it's so funny because many of them have never read Keynes. So the irony is really thick. They're following what they think is a great economic nostrum that didn't work for the master. And by the way, sorry.
Don't worry, no one's talking to you.
It didn't work for Milton Friedman. He thought you were insulting him if you asked him the direction of the stock market. And Paul Samuelson, of course, so famously said, the stock market has accurately predicted 9 out of the last 5 recessions. So you're thinking that you're going to beat the Masters at a game they didn't even play is real foolishness.
Now, foolishness also comes into the topic because of where we are right now when it comes to monetary policy and Treasury rates. Right. And I want to give you an opportunity to kind of contrast the whole idea of what's going on in the bond market with what you see as some value investments that are right in front of many people's noses, but because they are obvious, perhaps, they're shunned.
Well, also because the efficient market theory says you can't have anything obvious in front of you.
Right.
This is the same theory that almost took us all over the falls when people were buying mortgages promiscuously because they didn't bother reading the documents. Somehow we've got to give the efficient market theorem a burial. It's done too much harm, but it does harm to investors every day if they think, well, goodness gracious, Google can't be cheap because it just looks like it's cheap and it can't be cheap. It's the old story of two economists who walk down the street. One sees a $100 bill lying on the sidewalk, and the other says that can't be. Somebody would have picked it up.
And that's the way to become poor.
Well, that's not the way to get rich. I know that.
Well, tell us about Google, and then I want to get your thoughts on Tupperware, because that also it accentuates something that I think you, if anyone, has really hammered home, which is that just because it's not a brand new investment doesn't mean you should overlook it.
What you need is a flow of continuous cash that you know will be there, so you can understand the moat that is allowing them to go on making money like this. And then you need to ask yourself, is this a much better flow of cash than I'll ever get from a 10-year Treasury? And as you know, and you were nice enough to let me rant about this in October, I think 10-year Treasuries are extraordinarily dangerous. I thought so when they were 2.5%, and I think that they are so when they're 3.3%. And I would far rather own a Google, which when you subtract the $117 a share in cash on its balance sheet, and there is no debt, I'd rather own that at equivalently 14.5 times earnings after you subtract the debt than any Treasury security or anything that's priced off a Treasury security.
So we've got Google. I want to also find out your thoughts about McDonald's, because that was a surprise to read.
Well, it's just such a terrific cash generator.
And you make that point about cash. It's different than earnings. I mean, you've got to understand. It's profits, and you don't have to learn a lot. I mean, you do, but you don't necessarily have to learn a lot of accounting gobbledygook to understand this. It's about profits, not earnings.
Yes. If you're running a local bakery, you know the difference right away, because a profit is what you can take out of the business and go spend on something else. Somehow on Wall Street, we're confused about that. We know what GAAP is, but whether or not you can actually take that generally accepted accounting principle something, and spend it, that's the important part. In McDonald's, the earnings are almost the same as what you'd call profits at a local bakery. But in so many other businesses, in General Motors.
I was going to say banks and General Motors, because I know you've written about General Motors, but you also allude to the banking industry as well.
Right, because Hugh McCall raced up to me, the famed banker for Bank of America, about 5 years ago and said, well, are banks cash generators? And I harumphed and I kind of spoke at random, and I didn't really give him a good answer. And the financial crisis taught me, no, not even almost. The paradox is banks are made out of cash. They are literally made out of cash, and yet they're rather poor cash flow instruments. They just don't spit out money.
At least not to shareholders.
At least not to shareholders. And now, in this moment, if a bank wants to pay a dividend, the Fed has to hold a prayer meeting first.
Well done. I didn't know that. We were going to get to that. I feel like a little bit like William Jennings Bryan is going to make an appearance here. Give you last 30 seconds Tupperware, because you've spoken about it before. I want to get an update.
Well, it's a great example of the most ordinary, mundane, but fabulous cash generator. And I love to speak about Tupperware for two reasons. It's made me a lot of money, but secondly, because it makes investment professionals blanch whenever I bring it up. That can't be a good idea. Well, it has been.
All right. We're going to leave it there, but I want to thank you very much, Michael Harkins, president, partner, Levy Harkins. Always a pleasure, always insightful, always learning. Thank you.